Hey everyone, my name is Jack, and in this video I'm going to break down the 5 main factors that go into your credit score and what you can do to make sure that you keep your score as high as possible. As you may already know, your credit score is one of the most important measurements to your financial health. Your credit score is typically what determines whether or not you get approved for a mortgage, an auto loan, and it can even determine whether or not you get approved to rent at an apartment. So it's very important to always keep tabs on your credit score and understand how it's scored in the first place. Without further ado, let's look at the 5 major factors that determine your credit score. The first and most important category is your payment history. Your payment history identifies whether you've missed any payments in the past and looks to see that you're constantly meeting your payments each month and aren't falling behind on any balances. Since it is the largest category in your credit score, it's imperative that whenever you have debt, that you always make at least the minimum payments on time each month, because a late payment can drastically reduce your score since it makes up such a large percentage of your total credit score. And this makes sense. Lenders want to make sure that you reliably pay down your balances so that if they lend to you, they know that they're going to get their money back in time. One foolproof way to avoid missing payments is to set up automatic payments through your bank or whichever credit card company you happen to be using. That way, if you forget to pay off the balance manually at the end of the month, you have a backup in the form of the automatic payment and you won't have to worry about having it ding your score significantly. Now, the second largest contributing factor to your credit score is your utilization rate. Your utilization rate looks at how much of your available credit that you're using in a given month. For example, if you have $5,000 in available credit and you're using a $1,000 balance, you would have a 20% utilization rate. The lower your utilization rate, the better. Generally, lenders don't want to lend to someone who is maxing out their credit and is stretching themselves thin, if you want to look at it that way. That makes you more risky since you're less likely to be able to pay off other balances quickly. Generally, you want to keep your utilization rate under 10%. That is, you don't want to use more than 10% of your available credit in a given month to keep your score as high as possible. Besides just using less debt, one way to lower your utilization rate is to apply for new lines of credit or expand your existing lines of credit. That way, even if you're spending the same amount in a given month, your utilization rate will drop since you have more available credit to start with. Your utilization rate is one of the easiest credit factors for you to change quickly, since you can stop using credit or can start using less credit to bring that utilization rate down. Now, in addition to your payment history and your utilization rate, the third biggest factor is your length of credit history. Unlike the utilization rate, there isn't a whole lot that you can do here to help this out other than let time pass. Since the longer you've had a card open, the higher this score impact will be. The longer you've held on to credit cards, lines of credit, or other debt products, the longer your length of credit history and the bigger positive impact this will have on your score. This is why you should be very careful before you decide to close a line of credit or a credit card, since that will lower your length of credit history and can really negatively impact your score. As a rule of thumb, you should never close any credit cards if they don't have an annual fee, since it's of no risk for you to hold on to them. And as time passes, your average length of credit history will build and your score should improve with it. But as soon as you close down one of those old credit cards, it's more likely than not that your length of credit history is going to drop down significantly and your score will drop as well. Now, if the credit card does have fees and it doesn't seem like it's worth it to hold on to it anymore and you'd rather close the line, just be conscious of the fact that it's going to affect this factor of your credit score potentially very significantly depending on how old the card is. The fourth largest factor in your credit score is your credit mix. Your credit mix just basically looks to see if you have a variety of different credit products, whether you just have credit cards or if you have a HELOC or a mortgage or maybe student loans or other types of debt products. It will take this into account, and generally lenders like to see that you can handle many different types of debt rather than just, say, credit cards. But this one doesn't have a ton of impact on your score compared to the last 3 I mentioned, so it isn't as big of a deal. So basically, if you can have different types of debt products open at the same time, it'll help this portion of your score, but it's certainly not as important as making sure that you always meet your payment history and keep your utilization rate low among the other factors as well. And the fifth and final most important category is new credit. This factor, like the name suggests, looks to see if you have applied for or have recently opened new credit. Having a lot of recent hard inquiries on your credit report can worry lenders into thinking that you're trying to max out your total debt load and can make you more risky in their eyes. A good rule of thumb is to avoid having more than 4 hard inquiries in any 12-month period, and to avoid hard inquiries altogether in the months leading up to a big loan application like a mortgage. Thankfully, hard inquiries are not permanent and they drop off of your credit report after 2 years. Now that you know the 5 factors, let's go over some quick tips for how to keep your score as high as possible. As I mentioned before, always make sure to at least meet the minimum payments each month on your credit balances.
I will do whatever you ask.
Even missing just one payment can really hurt your credit score and can set you back even years, depending on how drastically it affects your score. Ideally, you should aim to pay off your balance completely at the end of each month, and that will also help your utilization rate since it'll keep it close to 0 when you're paying down your whole balance each month. As I also mentioned earlier, don't close down old credit cards unless the fees just really don't make sense to keep them on anymore. When you close out your older cards, you're instantly eliminating the length of credit history that you had with them. And finally, just be careful when you're applying for any new credit, since that hard inquiry is going to affect your score whether or not you get approved for the card or whatever the debt product is at the end. If there's a way to avoid having a hard inquiry on your credit report, definitely take that alternative route. But all this really comes down to is being responsible with your credit and taking care of it and making sure not to take unnecessary risks or making moves that would hurt your score over the long term. That said, I hope you were able to learn a lot about how a credit score works and the steps that you can take to improve it now. If you found this video helpful, be sure to give it a like. It helps the channel out a lot. If you have any questions that went unanswered, be sure to leave them in the comments below. Until next time, take care.